In New York, and this is Bloomberg Technology, bringing you all the top stories in tech worldwide. Coming up in the next hour, Chamath Palihapitiya of Social Capital joins us for an extended conversation on the biggest issues facing tech and VCs right now: regulation, diversity, and of course, Facebook. Plus, Apple sold more than 50 million iPhones in the last quarter, but is it enough to keep demand in the global smartphone market up? We will speak with Gene Munster of Loop Ventures. And the Runway is expanding its benefits policy, offering leave packages to hourly employees. We're going to hear from CEO Jennifer Hyman, who says more companies need to be doing the same. But first, to our top story. Just last week, we reported that Chinese smartphone maker Xiaomi could be the biggest IPO in 4 years with a $100 billion valuation. But now, that valuation may be not so high at all. Xiaomi may be looking at a valuation closer to $60 to $70 billion. Why the cut in price? We're joined now by Bloomberg Tech executive editor Tom Giles in San Francisco. So what's going on here, Tom? Why the fluctuation?
Not quite that $100 billion range. We don't know where the final numbers are going to come in. This is all still in flux. But I think it's about what you think of Xiaomi as being. Is it a smartphone maker? Is it an online games provider? Is it an ad provider? And it's all of those things. But think about its biggest source of revenue is smartphones, but they're not a big source of profits. And so the question becomes, do you think about it as like a smartphone maker, like you would value, say, an Apple or a Samsung, or a services provider, like a Tencent, even an Alibaba, for example? And so that's where you get this fluctuation in valuation. It was a big prospectus, several hundred pages. As time went on, more and more people delved deeper into it and made that realization, oh, this is what Tencent really is, and this is where its profits come from. Lei Jun has said he doesn't want it to be thought of as a smartphone maker, even though, again, that's where a lot of the revenue comes from. That's where you've seen a lot of really rapid-fire growth in recent months, but not where the profits are.
Still, this is a company that really wasn't growing very much a couple of years ago, and then, we saw this huge turnaround. How excited are investors by Xiaomi in particular?
Well, you're right. A couple of years ago, Xiaomi was really facing some tough times. We were talking about how everything had gone wrong there, how demand had just plummeted for their products. But they set up these pop-up stores. They got into a wide range of products. Air purifiers is my favorite Xiaomi product. And that's really caused a turnaround, and it's really caused a change in that company's fortunes. Even though the valuations may not be quite as lofty as the $100 billion, there's still a lot of interest in what this company does and what it represents and the growth potential that lies in its business.
All right, Tom Giles, our executive editor in San Francisco, thank you so much. Sticking with IPOs, the Swedish fintech company iZettle announced its intention to file for an IPO on the Nasdaq Stockholm Stock Exchange. The company competes with Square and Canada's Shopify and plans to raise $226 million. The IPO is expected to be completed this year. Carnegie Investment Bank and JP Morgan will act as joint global coordinators and bookrunners, with Barclays also assisting as bookrunner. Coming up, we're going to hear from one of tech's most influential and provocative voices. Chamath Palihapitiya, founder and CEO of Social Capital, is here. And if you like Bloomberg News, check us out on the radio. Listen on the Bloomberg Radio app, Bloomberg.com, and in the U.S. on SiriusXM. This is Bloomberg. executives from Alphabet, Amazon, and Facebook are planning to attend a meeting at the White House this Thursday on artificial intelligence. It will be the first meeting between Amazon, in particular, and the White House since President Trump began targeting the company via tweets in March. Will the meeting mark a new chapter between big tech and the Trump administration? Here to weigh in on that and more, Chamath Palihapitiya, founder and CEO of Social Capital. He joined Facebook when it was just a year old, left to start his own venture capital firm, has invested in companies from Box to Slack, and is making big waves in terms of just how business gets done in Silicon Valley.
Hi.
So, hello, great to have you back. Do you think this administration gets what needs to be done when it comes to encouraging innovation versus regulation?
I think the practical answer is that it is too nuanced to really understand from so far away. I think the good news is things like these meetings probably say there's some amount of effort being given, but the reality is most people in Silicon Valley don't even understand what AI is. And so the idea that, until we really grapple with what it really means, what actually exists, fact versus fiction, it's probably going to take many years before government really understand what's at risk and what's at play.
We saw Mark Zuckerberg testify before Congress. Many of the lawmakers didn't seem to quite understand how Facebook works. That said, do you think tech needs to be regulated? And do you think Congress can design the right regulation?
Well, I think the right way to think about this is when technology was a small part of the economy, it was probably best left alone. And I think we did a good job of self-regulating. Now the reality is technology is pervasive, right? There is no industry that isn't being refactored or remade by something new using technology at its core. And so with that, I think should come a natural expectation that we need to live by the same rules as everybody else does.
So a few months ago, you talked about how you feel tremendous guilt about what you built at Facebook. It caused a bit of a stir, as some things you say do. And you later said that you genuinely believe Facebook is a force for good in the world. That was before Cambridge Analytica, and there may be many more Cambridge Analyticas. We have no idea how many. We have no idea how many millions or even billions of people may have had their data compromised. So how does that impact your level of guilt now?
Look, I think the reality is that Facebook is probably going to be the company that leads the way out. But the reality is that there's a bigger problem, which is not a Facebook problem. It's a question amongst all of us as consumers. We have grown addicted to things that are free. And we very rarely pay for things when asked to on the internet. It's just not an expectation. But in the rest of our lives, we actually expect to pay for things. Ford doesn't give us free cars. Whole Foods doesn't give us free grapes. We have to pay for all of these things. And with those payments comes expectations and rights and privileges, et cetera. And so similarly, I think what we have to do as consumers is ask ourselves, how much of this do we want to have for free? And if we want rights, how much are we willing to pay for those rights? And those rights should extend to things like data privacy, et cetera. I think in that is the solution to future versions of this problem.
So you think Facebook should do a subscription model?
I think that's too tactical of a solution. I think it's a bigger question at hand, which is we have all assumed that the only way to make money on the internet is to give software for free and then use advertising to make up the difference. The problem with that is that we have a very weird and undefined gray area between who is the consumer, who is the customer, and how much of a product are you a part of. And I think that's where you have to introduce things like payment and subscription so that those marks are clear. For example, when you look at Netflix's business model, it is unambiguously clear. There is a bi-party relationship between Netflix and the consumer. Spotify has the same thing. Apple in many ways has the same thing. When you're a customer of Amazon Prime, you have the same thing. And so I think there are many examples now of an evolution of internet business models. And for example, in my organization, a lot of what we talk about is that. And how do we move away from just relying on ad-supported businesses and think about and embracing subscription because it clarifies a lot of these problems.
So let's talk about something we definitely don't get for free, and that is a Tesla. You once said that you think Apple should buy Tesla and make Elon Musk CEO. That was a long time ago. The last few weeks, we've seen Elon Musk calling analyst questions boneheaded and boring. We've seen bad April Fool's jokes. What do you think about that kind of behavior? Is that okay?
So unlike most people who read the peanut gallery version of that earnings call, as a large holder of the convertible bonds, I actually listened to the call. And honestly, what I would tell you is that I think that a lot of this stuff was overblown. Now, in fairness to public market investors, they provide critical liquidity for his companies. And specifically in Tesla's case, they are at a critical point where they may need more money. And so I do think it makes sense to make sure that you have the right kind of exchange. I'm not sure, though, quite honestly, whether quarterly earnings calls are the best ways to get at them. I think they're too perfunctory in general. And for a business as nuanced as Tesla, there's frankly really no opportunity to ask the right questions. In fact, what I would rather see Elon do is take the 4 or 5 analysts that really understand the business, and at the top of the list I would put Adam Jonas, and I would bring him under the tent and say, let me really explain these businesses to you, and then have you articulate that to the rest of the Wall Street. And I think that would probably be a step that bridges the gap between people's interpretation of the call and people's frustration with the actual content of the call.
Let's talk about Apple. You know, in the past you've talked about how they have a problem with innovation. We've seen, however, Apple earnings, and I know we don't love quarterly earnings, but defy expectation just by being stable and sort of defying the smartphone market slump. Do you think Apple still has an innovation problem?
I think that Apple has a fantastic cash machine. I don't think Apple has demonstrated yet what the next lily pad is. And why that's so critical in technology businesses is that the underpinnings of your business model are constantly changing. So, simple example, if we move from ad-supported businesses to subscription, but we may move from subscription to something else. There may be something that comes after a phone. Perhaps it's a VR headset. In all of this is a lot of change. And so in order to accommodate change, I think the best course of action is to try many things. Be okay with failure. Don't be embarrassed by it. It's learning, and it'll help you refine the ultimate thing that works. And so I, as an investor, would love to see more public-facing experimentation that says, we know that the iPhone business isn't going to be around forever, and so we're going to try some things at scale. Now, in fairness to them, they've tried some things that are exceptional. For example, AirPods are fabulous. That is an unbelievable product. I think everybody who uses them loves them.
But certainly not the price point of an iPhone, even though they are still expensive.
It's an excellent point. It is not going to be the thing that replaces the iPhone business. And so you need to find multi-$100 billion or trillion-dollar markets. And for whatever reason, there are only a few: healthcare, education, autos, housing. And so they have to try something big, I think.
You've talked about some public market stocks you think are undervalued, Box, for example. What else? Where do you see opportunity that public market investors aren't seeing?
Yeah, so if we go back to where we started, I really think that over the next 15 to 20 years, consumers are waking up to the realization that they are going to want to have rights and be the ultimate customer. What that means is I believe businesses like Netflix, Spotify, and there are many others that are subscription-based are going to do incredibly well. And in fact, I think that they will massively overperform other kinds of business models. And in part, what that means is those other kinds of businesses, ad-supported businesses, will get revalued and re-rated, in my opinion. There will also be the scepter of regulation. There will be the scepter of privacy risks. And so, to me, where we are spending a lot of time is finding companies that express that view, subscription-based relationships with customers.
All right, we're continuing our conversation with Chamath Palihapitiya of Social Capital. We're going to talk about his mission to bring more equality to this industry. And Bloomberg Technology is live streaming on Twitter. You can check us out at Technology. Be sure to follow our global breaking news network at TikTok, on Twitter as well. This is Bloomberg. Social Capital is a unicorn among VC firms with four female investment partners in an industry where women are grossly underrepresented. But progress elsewhere has been incremental. But it won't be for long if Chamath Palihapitiya has his way, the founder and CEO of Social Capital, with me here now. So why isn't the industry changing faster? Why are you one of the few people out there talking about this?
I think there are two reasons. The first is that there is a dirty little secret in Silicon Valley, which is that there's not a lot of incentive to change because technology markets are frankly quite small still, and they're growing very, very quickly. And so the returns you generate by basically staying the same are high enough to keep you in business for a very long time. So the fundamental underlying incentives for general partners or venture capital firms to retool don't exist. Now, why are we doing it differently? Because to be honest with you, I just think it's a poor business decision. I think that if you put the best people on the field, and in order to get those people, you close your eyes and ask the same questions and make the same judgments, you end up with a more diverse team because you find that there are people you would otherwise exclude who are frankly better than the people you would otherwise pick.
Give me the evidence. Is it showing in your returns?
Yeah, and in fact, the way that we look at it quite simply is like, how performant are we relative to the S&P 500? And it's dramatically overperformant. And again, I think back and I say, who has built the top decile firm in Silicon Valley over the last 10 years? Right? Who can compete with Kleiner or Sequoia or Excel? And I would say that there are three organizations, Andreessen Horowitz, Y Combinator, and ourselves. And now we've all taken different approaches to get there. My organization only started 7 years ago. So to have done this in such a short amount of time, I think represents a commitment to this idea that really good, thoughtful hiring of people who are qualified, independent of race, gender, creed, etc., just turns out to be the smartest business decision you can make, so why not do it?
One of your new experiments is called Capital as a Service, where you've basically built this machine or this algorithm that will identify companies, global entrepreneurs around the world without any humans being involved. And basically the computer decides whether or not they get funding. What sort of results are you seeing? Like, does this model actually work?
Yeah, in fact, humans do get involved. It's just that after the computers make a recommendation. And what we found even in our first batch was these were businesses that 40% were founded by women, 80% were founded by minorities. They were companies that spanned 17 countries of the globe, many of the states in the US that would never have received venture capital funding, meaning not California, not New York. And so what we find is actually what you think we find, which is there are amazing people everywhere, and they're trying their best to solve really important problems that improve the quality of life of the people around them. And when you take a need-blind approach and instead ask simple questions that have everything to do with the quality of the business versus the demographic makeup of the founder, you invariably find an amazing collection of people.
And you intend to scale this to 10,000 investments next year.
I have told the team that my goal, if they can execute and build this thing for scale, is to support 1,000 companies this year and 10,000 a year every year thereafter. Now, listen, part of managing a really sophisticated technology team is to set audacious goals. It's not clear yet whether we'll be able to build it to such a scale. And to be honest with you, it's also not clear whether 10,000 investable opportunities a year exist. But just by mandating something like this, I think what it allows us to do is really ask the hard questions. How do we train our algorithms? How do we use data judiciously? How do we help businesses that may be very close to funding get over the line and be better? Mm-hmm. How do we actually become more democratic in teaching people how to be entrepreneurial? How do we integrate with the massive companies like Amazon and Google so that people can start businesses in an even simpler way? So it's forcing these conversations, and frankly, in many ways, it brings me back to my roots of just building really interesting products that start with very small steps, but can turn out to be quite transformational over years.
Speaking of AI and algorithms, I know you see a big opportunity there. How are we thinking about this, and are we thinking about AI in the right way?
I think that AI is sort of a misnomer, and the reason why it's a misnomer is that people think about these computers making decisions for us. But there's actually an important step that happens before it, which is how does a computer get trained? Well, a computer gets trained with enormous amounts of data. And so really what we are fighting...
Well, and data and AI and computers, they're not necessarily unbiased.
They're not. Mm-hmm. And that's about the iteration of how things improve over time. But the point is that this is a land grab for data. And why there's so much concern about these large companies, the large internet companies, is because of the enormity of the data that they've collected. Because on the one hand, you could use it to improve basic core services, but on the other hand, it may be too much power in the hands of a few. And so what we really need to do is have a more nuanced discussion. When we talk about AI and we talk about the perils of it, it really comes down to who is collecting the critical information that will train our computers over the next 20 to 30 years to make important, differentiated decisions on our behalf.
So who is? I mean, who's in the lead?
Well, there's the obvious companies in certain categories. So if you said, who is going to be the leader in collecting data around consumption, I would say it's Amazon. If you asked about, intent, it would be Google. If you talked about content consumption, it would be Facebook. But for example, in healthcare, there's no clear winner yet. In education and adaptive learning, there's no clear winner yet. In financial regulation, the issuance of credit, there's no clear winner yet. So there are these many, many markets where we don't know yet. And so now it's about figuring out how to start companies, quite honestly, who think about this as their core primary reason to exist, and then collect data and then use it in a really thoughtful and honorable way.
I have to ask you about the SPAC. So you've raised $600 million to help startups go public. And $690 million, excuse me, to help startups go public unconventionally. Everybody wants to know if a startup has been chosen. Has a startup been chosen?
I can't comment.
I'm trying to read your body language. You're very excited about it.
No comment. No comment.
Would you consider an overseas company if they were consumer friendly?
I really can't comment on
Okay,
yeah.
But why?
Part of it is that I want to respect the confidentiality of the process, but also part of it is just the practical realities of SEC regulation, which I want to honor. And so until there's a deal to be done, we can't say anything. But I really think, by the way, more generally speaking, we're going to find a lot of utility for products like this, because what it allows us to do is bring scaled financial capabilities and toolboxes to tech businesses. And I think what that will do is accelerate great companies to being fantastic.
All right, Chamath Palihapitiya, founder and CEO of Social Capital. Always great to have you on the show. Thank you so much.
Thanks, Ann.
For stopping by. Coming up, Apple's big business is the iPhone, but how much longer can this hold true? We're going to take a look at the current health of the smartphone market next. And later in the show, the CEO of one of the biggest startups in e-commerce speaking out for employee benefits for all. We're going to hear from the CEO of Rent the Runway, Jennifer Hyman. This is Bloomberg. This is Bloomberg Technology. I'm Emily Chang in New York. Earlier this month, Apple reported second quarter results that thrilled investors, but all eyes continue to be on the moneymaker, and that is the iPhone. The newest device, the iPhone X, became the best-selling iPhone of the quarter. At the time, CEO Tim Cook told Bloomberg it was the most popular iPhone every week in the quarter. I think that is an incredible result if you think about it. And when asked about smartphone market growth, Cook pointed out that 500 million feature phones were sold last year, which could still be upgraded. He argues that the iPhone has a relatively low market share, but points to a huge opportunity in India. Though we know that people are willing to pay $1,000 a phone now, how frequently will upgrades actually occur? Here to discuss the growth of the smartphone market, or lack thereof, Loop Ventures managing partner Gene Munster in Minneapolis, who's been covering Apple for years. So, Gene, of those things that we heard from Tim Cook, is there any myth there that you want to bust, or anything you'd in particular shine a light on?
Well, there is a myth around how investors think about this story, and it's important, a preface to my comments, is that we've been in this anxiety over iPhone growth for the last 6 years, and understandably so, because the iPhone grew at 37% in 2015. 2016, it was down 8%, but I think we are moving into a different paradigm in terms of how people are going to think about the Apple Store, and I'm just going to quickly go over that and then hit Tim Cook's comments. But the new paradigm is less anxiety about the iPhone and a general belief by investors that this is a generally stable business, not a high growth business, kind of a 0 to 5% growing business, but stable. And second is that stability is a platform for them to build services, and that grew nicely in the March quarter at 30%. And last is the share buyback. So that kind of that trifecta, I think, is how investors. But that does not change this the narrative around what is the growth. So I want to quickly talk about what he had said, is that there's effectively they have 17% market share. The smartphone market's about 1.3 billion units a year. What Cook said on the call is there's 500 million feature phones. That's a flip phone, hard to believe, but 500 million feature phones sold every year, and they can kind of inch into that. And my busting of the myth around this is I think it's unlikely that they're going to get much of any traction at the very low end, which is that market. But I do think that they can grow fractional market share. To put that into perspective, each 1% share that they gain is about 13 million units, or about 4% increase in the iPhone base. And so it is easy for them to just inch up. So that part of Cook's comments that it's a big market is valid.
So you think that the price of the highest end iPhone could go up significantly and that consumers are willing to pay. And Tim Cook told me when I spoke to him ahead of the earnings call, he's not worried about the price of that $999 iPhone. Clearly it's selling, but how much more are people going to be willing to pay, and how much can Apple continue to rely on these higher ASPs, or average selling prices, for the phone in a particular quarter?
Well, they can rely on that because, as Tim Cook said, this is the phone market's the best consumer market in the history of the world. And so I think that there's a big base that they can tap into, but it's a smaller group that wants that. But I'm going to put some perspective around the opportunity in the high end, is that they have seen better sales in their iPhone 10 than they typically see. And obviously the iPhone 10 is more expensive than a normal phone. So I think that the proof is in the results for the last 2 quarters, is consumers are valuing their phones at greater levels, and they're willing to pay up for that. And the reason why this is going to continue, and they're going to get more options to pay up, because high probability, Bloomberg has been reporting a lot about this, about the new family of phones that is going to be out in the fall. One of them is probably going to be 25% bigger and could be a $1,400 ASP on it. Now that's compared to the $1,200, kind of the high-end ASP for the iPhone 10 now. So my point is that they're going to have more options, even more options to spend up, and I think that we've learned that this, in fact, will gain traction.
We've talked about Xiaomi going public earlier. How much of a threat is Xiaomi to Apple?
That's one of the reasons why this iPhone business probably won't grow above 5% over the long haul. Is that Xiaomi market is the 500 million units that is at the flip phone market. Getting those to convert over is going to be very difficult for Apple to win those, given those high ASPs that you're talking about. So it's a big threat. It's why the iPhone business will not grow at probably 10-15% in the future. But I think that it will. So that's, I think, the competitive threat there.
We were speaking with Chamath Palihapitiya earlier, who talked about Apple's sort of innovation problem and said it's unclear what the next lily pad is for Apple. You mentioned earlier the trifecta: iPhone, services, share buyback. Is services that next lily pad, or are you looking for something more?
We are, and we have a history of getting some of these right and some of them wrong. But it's the one other factor here in the story is that there is optionality value on other things that they could get into. And probably the two most obvious is something around wearables. They've made recent acquisitions around glasses. This would be one around Tim Cook's favorite themes, is augmented reality, and kind of taking that to a level where its consumer adds a lot of value in consumers. So I think that's a big opportunity for the company. And then second, there's the piece around content, which plays into services. You're going to hear more from Apple over the next few years on that front. And then the last real wild card is around the self-driving autonomous cars, autonomous vehicles. They have a project called PALE, the Palo Alto to Infinite Loop. And so there you could hear more about what they're doing in self-driving cars. So
we're all watching this potential trade war with China, and Apple could, in particular, be harder hit than other technology companies, given how many smartphones it manufactures in China. What is the worst-case scenario for how Apple and the smartphone market at large could be hit if this trade war really does explode?
Well, you have a market. The big issue here is just obviously with the price that consumers are going to pay. And so it's still unclear about if this war actually plays out and what the impact will be. But here's the worst case scenario is that let's say that there's a 20% tariff or 30% tariff that goes on iPhones. And instead of being an average selling price is $730 like it was in the last quarter, that goes up to $830 or $900. That's going to diminish their market share. And that could take the iPhone from being 3% growth last quarter to down 5%. I mean, you can build some pretty dangerous scenarios where people just simply can't afford. It's important to note that $200 is a lot of money for most people. And I think that can have a negative impact on the iPhone business.
All right, Gene Munster, Managing Partner, Loop Ventures, as always, thanks for joining us. Coming up, Rent the Runway CEO Jen Hyman joins us to talk about how she is making changes to ensure all employees at the startup are treated fairly and that other companies should too. And later, picking up the slack, just how the online office platform Slack has been bringing users on board. This is Bloomberg. The U.S. is in the midst of unprecedented strength in the labor market. The April jobs report showed the U.S. unemployment rate dipped below 4% for the first time in 17 years. But the workplace is changing. In 1960, only 20% of mothers worked. Today, 70% of American children live in households where all adults are employed. Meantime, the majority of workers spend more than 40 hours a week on the job. Productivity has increased 400% since 1940, while benefits like leave and health care aren't guaranteed. And in the tech industry, there is a rising split in the workforce. Competitive pay with great benefits for salaried workers, while warehouse and hourly employees can be left with little to no incentives. Rent the Runway CEO Jennifer Hyman wrote about this issue in a New York Times op-ed this week, saying, "Our hourly employees working in Rent the Runway's warehouse, on the customer service team, and in our retail stores had to face life events like caring for a newborn, grieving after the death of a family member, or taking care of a critically ill loved one without the same level of benefits." Jennifer Hyman, CEO of Rent the Runway, joins me now because you have done something about this and you've made a big change. Tell me how you came to this realization.
Well, first, the change is we decided to equalize benefits across the company, across all functions, meaning that parental leave and sabbatical policies and paid family sick leave and bereavement are the exact same for corporate employees as they are for warehouse employees.
Now, at the outset of your op-ed, you say, I wasn't doing this and that was a mistake. I mean, why? Is it because it's always been done that way? Is it because it was cheaper?
Yeah, no, it actually was. When you found a business, you really take your cues on corporate culture from already successful companies. So I just looked to what companies that I admire were doing, and they were doing incredibly generous things for their employees in corporate, and they had very standardized, more skimpy policies in their warehouse and in their customer service teams, and I just followed suit. And it really took me the consideration of now having a team of 1,200 plus people with a company that is doing extremely well, understanding that I'm in the position I'm in because of the entire team, not just my corporate team. So why is it that my pregnancy is more important than someone on my seamstress team? It's actually not. Like, a life event is as important for any person in my company.
So this is going to be expensive, isn't it? And how do you account for that expense?
First of all, while it might be an expensive upfront cost, I do think that it'll all come out in the wash in terms of higher retention rates, having more productive employees. The cost of bringing in and training new employees is extremely high. And then the loyalty that all employees will have to Rent the Runway. What was remarkable about these changes is we didn't change that much as it related to corporate employees because our benefits were already really generous for that population. So we just equalized the benefits, and the people that had the most positive reaction to it was our corporate employees, because people want to work at companies that exemplify their values. 70% of millennials, which is the majority of the labor force right now, say they won't work at a company unless it exemplifies a value set that they have. And I think this value set around treating everyone with respect and equally is something that's extremely important to the younger generation.
So let's talk about some other companies with these sort of two-tiered workforces, like Amazon or like Starbucks? How does what you're doing compare to them?
Well, it's very different from them. So as an example, we have a policy that is 4 weeks of bereavement leave. And now that 4 weeks of bereavement leave is for anyone on the team that is grieving for a family member. And that is a really generous benefit that Sheryl Sandberg put in place at Facebook, and lots of other companies followed suit after she did that, but they did that for their corporate teams. You know, why is it that a death in the family is more important for someone who works in corporate? It's just not. And, you know, the thing that was really important to me was thinking through the opportunities to arrive in a corporate job. What has given me the privilege of being able to be a founder and be a CEO? So yes, I've worked hard, but I also grew up on the right block with the right parents. And a lot of people who work on my operations team, in my customer service team, didn't have the same educational opportunities. They certainly didn't have the same career opportunities, and they work just as hard as I have.
So what's the call to action here? What should companies like Amazon, like Starbucks, what should they be doing?
I think that if someone works for your company, whether they are salaried or they're hourly, they should be treated equally. And you should do whatever is financially viable within your company and stage. So I'm not making a claim that Rent the Runway's benefits are the most generous out there, because we're still growing. We're not a company of the size of Amazon. But I am making the promise that everyone's equal, and that as Rent the Runway continues to grow, I'll continue to deliver more and more value to my employees.
So while I have you here, you know, we've been talking a lot about diversity. We've got the Bloomberg Business of Equality Summit going on here at headquarters today. You know, we talk a lot about companies that are, you know, working really hard to change it, where the numbers are moving. Rent the Runway is a company that's been diverse almost from the very beginning, and in part, well, I don't know. You tell me why. Is it because you have a female CEO? Is it because you were able to attract more women on the executive team? You know, give me your progress report and what others can learn from it.
Well, we've always been diverse, both in terms of gender, but also minority and background from the beginning of Rent the Runway. We are a team that has been 70% female from the beginning. I think that no one ever wants to be the minority. Because we started off with a diverse team, it's easier for me to be a diverse team today and to attract minorities, to attract women, because they see that those women and those minorities are leaders at every level of the company. Another problem that companies have is if you have an upper echelon of management that's all white men, but then you say you have diversity on your team, there's no one that I can look to who's like me. And therefore, why do I want to symbolize what all women think? Like, you never want to be the only woman in the room or the only person of color in the room and feel like you have to express the opinions of an entire race or an entire gender.
So why is it taking so long for a company, let's say Amazon, because it's a big e-commerce company, and women drive 70 to 80% of consumer purchases? Why doesn't Amazon work, well, even more ammunition? Why doesn't a company like Amazon, why can't it change more quickly to represent its customer
base? Listen, I think that it's complete BS that companies aren't 50% female, and that it is because of a lack of values. Okay, you showcase your values by nature of who you hire and who you promote and who you let go from your organization. So cultures persist because of the CEO and the decisions that the CEO makes. And it's often more important who you choose to promote and let go from your organization than who you choose to initially hire. So if you're not hiring women, if you're not interviewing women, it says something about your value set. In the same way as if you are treating your corporate, more educated, whiter employees better and differently with better perks than your less educated and more diverse warehouse employees. That says something about the values that you hold dear, and I think we need to question, what are those values? Don't claim to be progressive and if you're not actually walking the walk.
Jennifer Hyman, CEO of Rent the Runway, thank you so much for joining us. You can catch that op-ed in the New York Times. Coming up, we speak to Slack's new Chief Product Officer, how the company's attracting new users to its platform. That is next. This is Bloomberg. Uber is getting an out-of-this-world boost to get cars off the ground and into the sky. The ride-hailing company announced a partnership with NASA to study urban manned aircraft. Uber will share its data with NASA in an effort to move the world closer to developing air traffic management systems for a world with flying cars. Now, Uber isn't building these flying cars, but is working with manufacturers in conjunction with its ride-hailing network to possibly develop flying taxi-like vehicles. Well, since its launch 4 years ago, Slack has risen to become one of the leading names in online workplace collaboration. And the company has just released its latest metrics detailing growth since September 2017. Daily active users has risen from 6 million to 8 million, and paid users on Slack has hit 3 million. Among its corporate clients, it now includes 65% of the Fortune 100 companies. Joining us now to discuss, Slack's Chief Product Officer, April Underwood. April, thank you so much for joining us. And Slack in the enterprise has been an interesting growth experiment for you. What are you learning about the difference between these enterprise users and those, consumer-focused, smaller group users that were so enthusiastic about Slack in the beginning?
Thanks so much for having me, Emily. So the last year has been really phenomenal for us. In addition to the milestones that you mentioned, we've hit 8 million daily active users. We have 500,000 organizations using Slack. One thing that we're really proud of is that we delivered a lot of new product last year that actually allowed more types of customers to use Slack. So in doing that, we brought on board a number of larger customers, the likes of Ticketmaster and REI and Moody's and Target. And many of those customers are taking advantage of our product that we launched last January called Enterprise Grid. So you ask what is different about these users, and what's fascinating about these customers is the more I spend time with them, I find that they want a lot of the same things that smaller organizations want. They want transparency, they want agility, they want the tools that actually allow their organizations, which are quite large, to be able to work as seamlessly and effectively as smaller organizations. And that's ultimately a lot of what we do at Slack. That's what we're focused on building, and that's really how we think about building a product that works for this diverse audience, from the smallest customers all the way up to those with tens of thousands of customers or employees thereof.
Is there a difference in user behavior and the stickiness of it when the product is integrated top-down versus bottom-up?
That's a fine question. I mean, I think we're still in early days of this. We created this category and identified early on that there was a need for a new way of working, and that something like Slack was going to be just critical for organizations to be able to work transparently and to have the communication tools that are needed to allow them to mirror their digital work, the work they do all day, every day, with their actual organization and how it functions. So what we find with those organizations is where there's that top-down buy-in, where we see CIOs at some of the companies that have started using Slack in the past few years really take hold and want to play a critical role in the success of Slack and its internal adoption. There's no question that is a huge boon to adoption and helps the organization adopt to this new way of working. But that being said, most of our growth across those 500,000 organizations that I mentioned has really oftentimes been bottoms up, where small teams within companies have adopted Slack because they wanted to work differently, and it spread like wildfire throughout the organization.
Now, Slack has also been especially focused on how it grows its own workplace, and I have to ask you, Slack released its new diversity numbers a few weeks ago. It improved on almost every measure, and Slack is constantly held up as this example of a company that's doing it right, or where something is working. 40-some% women across the company, 48% of managers are women. You're seeing improvement in underrepresented minorities. If there is one takeaway, what is one thing that companies can do to get numbers that look more like yours?
I think that if there's any secret to how we've gotten to where we are, it's by starting early. So Slack was founded by 4 founders, all men, and what that early team did was they started talking about and intentionally focusing on bringing diversity and inclusion to Slack from very, very early on. And with some of the other work that I do outside of Slack with my investment group, #Angels, that is one of the things that we advise the founders of the 50 companies we back to do, which is that diversity can't be something you start focusing on when you're 100 or let alone 1,000 or 10,000 employees. When it gets baked in from the outset, you have leaders that represent the kind of employee base that you want to build and probably the customer base that you want to serve. And so that would be the one point of advice is start early, and if it's too late for your company because you're already quite large, then that support and attention from the top is really critical. And Stuart has always been a big advocate for diversity and really drives a lot of that focus within the company.
Stuart Butterfield, your CEO. All right, April Underwood, Chief Product Officer at Slack, thank you so much for joining us. And that does it for this edition of Bloomberg Technology. Concrete takeaway there. Tomorrow we're going to bring you highlights from the Google I/O Developers Conference. News just out. Google's Assistant will now book you an appointment on its own. We're going to bring you our conversation with Richard Gingras, Alphabet Vice President of News. That's all for now. This is Bloomberg.